The Maverick Podcast. Welcome back to the Maverick Podcast, where we unpack the most astonishing stories in finance and beyond. Today, we're diving deep into one of the most legendary and cautionary tales in Wall Street history, the rise and catastrophic fall of long-term capital management, or LTCM. Buckle up, because this story involves Nobel laureates, billion-dollar bets, and the near collapse of global markets. Our story begins in Greenwich, Connecticut, 1994, inside a quiet, exclusive office named Osprey House. Here, Wall Street legend John Meriwether, once the star trader at Salomon Brothers, assembled what can only be described as the financial dream team. Picture this. Nobel Prize winners Myron Scholes and Robert Merton, famed for their groundbreaking Black-Scholes option pricing model, join forces with former Fed Vice Chairman David Mullins and the best quant minds from Harvard and MIT. Together, they raise an astounding $1.25 billion from elite investors, including central banks of Italy and China, CEOs, and prestigious universities. The formula? Sophisticated math models designed to exploit tiny pricing discrepancies in financial markets. A strategy known as convergence trading. Think of it as picking up nickels in front of a steamroller. Tiny profits, yes, but multiplied massively through extreme leverage, borrowing as much as $30 for every dollar invested. By early 1998, LTCM was managing an eye-watering $125 billion in assets, with derivative exposures ballooning to a staggering $1.30 trillion, about 5% of the entire global fixed income market. Initially, their success was dazzling. In their first full year alone, LTCM returned an incredible 21%. By 1995, they hit a jaw-dropping 43%, beating the S&P 500 itself. Investors couldn't resist. LTCM became Wall Street's envy and embodied the genius of modern finance. But here's the thing about geniuses. They often underestimate chaos. And chaos came swiftly. In 1997, economic tremors began in Thailand and quickly engulfed Asia, shaking global confidence. LTCM's profits dipped, but worse was yet to come. By 1998, Russia was spiraling into crisis, eventually defaulting on its debt on August 17th. Markets panicked, and investors fled to safety, causing unprecedented volatility. LTCM was caught massively short liquidity. Their sophisticated models, built on historical norms, utterly failed to anticipate this catastrophic convergence of events. August 21, 1998. LTCM lost a stunning $553 million in one day. By month's end, nearly half their capital had vanished. Leverage exploded to 250 to 1, turning LTCM into a ticking financial bomb. By September, the fund was just days from collapse, threatening to drag Wall Street and global markets down with it. Enter William McDonough, president of the New York Federal Reserve. On September 23, 1998, he summoned the CEOs of Wall Street's biggest banks, including Goldman Sachs, JP Morgan, and Merrill Lynch, to the Fed's ornate boardroom. After frantic negotiations and even a dramatic rejected offer from Warren Buffett himself, a consortium of 14 banks injected $3.6 billion to rescue LTCM and stabilize global markets. By early 2000, LTCM was quietly dissolved, a ghost of its former glory. The rescue worked. Markets survived, but at what cost? LTCM revealed systemic weaknesses that foreshadowed the global financial crisis a decade later. Regulators highlighted problems: too much leverage, too little transparency, and a dangerous belief that some institutions were simply too big to fail. Today, the LTCM saga serves as a stark reminder that genius and hubris often dance dangerously close in finance. It's a cautionary tale about the limits of mathematical models, the hidden risks of leverage, and the thin line separating brilliance from disaster. And that's it for today's episode of the Maverick Podcast. Subscribe for more gripping stories where money, ambition, and fate collide. Until next time, keep questioning and stay Maverick!